So let's just focus on the right-hand side of this slide. So really how it works as it relates to our strategies, what we're trying to do is we're trying to take a similar amount of credit duration exposure, credit duration being the measure upon which the price of your security or your portfolio goes up and down based on the amount of change in the yield of the bond. So, for example, if I had a 10-year credit duration exposure and yields went up by 10 basis points, I would lose 10 times 10 or 100 basis points or 1% in return. And so that's kind of the measure that bond guys use as a general measure to determine how much risk they have in their portfolio. So as a general guideline for us, we're looking to have a portfolio that has a similar amount of credit risk to that is in any one of your traditional Canadian index bond funds. Okay. So that would be, index duration is about 7.5 years. I've given an example here where we have 7.7 years of duration. But on the left-hand side of this page is an example where your passive index bond fund would go and buy a 10-year bond. Okay. The blue line is the credit curve on both graphs. So at that 10-year point, if I follow the orange line down to the x-axis, that gives you credit duration exposure of 8.5 years. That's the risk that you're taking in buying that bond because, again, if yields go up by 10 basis points or prices go down the equivalent of 10 basis points in yield, you're going to lose 85 basis points in terms of return. That's the risk you're taking. If you follow that over the y-axis, the return you're getting for that is 130 basis points for that credit risk. You're also getting this tiny little piece, and this is kind of, in my mind, the real rub about what Hull and White we're looking at is this kind of security appreciation that people don't really think they get on a bond, but they actually get it because as you move forward in time, the yield actually drops. And when the yield drops, the price must rise. So that's this tiny little piece of security appreciation of 36 basis points. So the total return that a passive bond fund gets for taking 10 years of corporate bond risk or 8.5 years worth of credit duration risk is 166 basis points. Okay. Now, what Hull and White figured out is that, okay, you can position yourself and get paid a lot better than that. And you can get that by positioning yourself on a steeper part of the credit curve. Okay. And so that's that in the example of what we do on the right in this illustration is at the 2-year bond point.
Right. I just want to interrupt here and say that the credit curve has to go to zero at maturity. It comes in as they pay the bond, it goes to zero. So the steepness of that curve is and this is, we'll talk about this in the future, but in Canada it's particularly steep, meaning that it's high, and then it kind of falls off really hard in the last few years.
Yeah, we can talk about why that is later, right. but yeah, so you have this kind of steep part of the credit curve, and you see that creates this green triangle, quite a large green triangle of profitability for you. So, if you just bought 1 2-year bond, you get 50 basis points of return just from falling down that credit curve. You'd also get 70 basis points of coupon yield. The difference is you're only taking 2 years of duration risk. So on a standalone basis, I buy a 2-year bond, I earn 118 basis points of return. I take 2 years of duration risk or slightly less than 2 years of credit duration risk versus the passive bond fund that's taking 8.5 years of credit duration risk and earn 166 basis points. So now I want to take a similar amount of risk to what the passive bond fund is taking. So instead of buying 1 2-year bond, I buy 4. So now I have about 7.7 years of duration exposure. So if the 2-year bonds that I own go up in yield by 10 basis points, I lose 10 times 7.7 or 77 basis points, which is similar to what the traditional bond fund would lose if yields went up by 10 basis points at the 10-year point. The difference for me, though, is I get to earn 4 times that 70 basis point coupon, and I get to earn 4 times the security appreciation as well. And so that leaves me with a static return in this illustration of almost 5% or versus theirs of 1.75%. And so that is a meaningful enhancement to the return profile in a product where, really at the end of the day, you're now long 4 2-year bonds And the reality in the investment grade bond space is that default is a very, very low likelihood. And even if it does become a potentially higher likelihood, you're much better off owning a bond that matures in 2 years than you are owning one that matures in 10.
Right. And so when a lot of people think about a traditional credit fund, I guess when these things first started, people used to go and just try to get the most juice they could in terms of going out the longer dated securities because the spread would be higher in absolute terms. And this is kind of flipping that on its head, saying, no, you're better off going and doing more of a short dated one.
Yeah, I mean, it's certainly that. I mean, the reason this is difficult is because it's not easy to, like, there's a lot of stuff going on behind the scenes to allow you to do it, right? So you can't just go out and, call up your broker and say, I've got $1, I want to go and buy four.
Right, because your funding is
Rogers
important.
bonds.
You fund a lot different than I do.
Yeah, because if you paid full funding costs in order to do it, then it would negate all the returns that you're going to get to begin with. So you have to be able to do it in a way that you're lending the securities that you own and you're borrowing the securities that you're short, and your net funding cost is just the bid offer cost between the two, as opposed to the full margin loan cost.
Okay, that's the first thing. And then you also have to be able to go trade these things, which is more of an institutional market. Obviously, most people can't do it.